There's a rule on Wall Street that has governed precious metals markets for over 50 years. It's one of those bedrock principles that traders, analysts, and central bankers have operated by for so long that it became almost invisible. The kind of rule you stop questioning because it's just always been true. The rule is simple. When the US dollar strengthens, gold falls. When the dollar weakens, gold rises. Inverse relationship. Reliable, predictable, foundational. And right now, that rule is breaking in ways that the financial establishment doesn't want to talk about in plain language. Because here's what's been happening in the real world, underneath the headlines about interest rate decisions and inflation data and whatever the market did on any given Tuesday. Gold has been on one of the most extraordinary runs in modern financial history. We're talking about a metal that spent most of the past decade being dismissed by the financial media as a relic, something your paranoid uncle bought and stored in his basement. The same analysts who once called it a barbarous relic with complete confidence are now quietly updating their price targets in a direction they never anticipated. And the dollar? The dollar has been doing what the dollar does, fluctuating, responding to Fed policy, reacting to trade data. But the old relationship, that reliable inverse dance between the greenback and the gold price, it's falling apart. And that breakdown is not a small technical footnote. It is one of the most important signals in global finance right now, and most Americans have absolutely no idea what it means for them. So that's what we're going to talk about today. We're going to pull back the curtain on why the dollar's gold problem just got exponentially harder to ignore. And more importantly, what it means if you're someone who worked for 30, 40 years and accumulated savings that you're trying to protect. Let's start at the beginning, because context is everything here. When the United States ended the gold standard in 1971, it was one of the most consequential moments in the entire history of money. Not just American money, all money. President Nixon stepped in front of cameras on a Sunday evening and told the world that the United States was suspending the convertibility of the dollar into gold. What that meant in practice was that the dollar would no longer be backed by anything physical. It would be backed by something far more abstract. Confidence, trust, the collective belief of billions of people that a piece of paper issued by the US government had value. For a while, it worked brilliantly. In fact, it worked so well that the dollar didn't just maintain its status as the world's reserve currency, it deepened it. The petrodollar system, where oil was priced and settled exclusively in US dollars, created a mechanism of structural demand for the greenback that no other country could replicate. If you were Japan or Germany or Brazil and you wanted to buy oil, you needed dollars first. Every single oil transaction on the planet ran through the dollar. That meant central banks everywhere had to stockpile dollars, which in turn kept demand for US treasuries permanently elevated, which in turn allowed America to run enormous deficits without experiencing the inflation that would have destroyed any other country doing the same thing. It was an extraordinary privilege. Some economists called it the exorbitant privilege, and they weren't wrong. And gold? Gold became an afterthought, a curiosity. The metal that used to anchor everything got mathematically displaced by the dollar system. When the dollar was strong, gold was expensive for foreign buyers and served less purpose as a store of value. When the dollar was weak, gold became relatively cheaper and demand picked up. The correlation ran reliably negative for decades. Asset managers programmed it into their models. Risk systems at the biggest banks in the world used it as a baseline assumption. Now look around you. That assumption is gone. What the data is now showing, and this is the part that should make every thinking American stop and pay attention, is that the traditional inverse relationship between the dollar and gold has structurally broken down. Gold has been moving higher not just in spite of dollar policy, but in a way that suggests the dollar's anchoring function in global finance is being fundamentally questioned at the institutional level. And I want to be clear about something here, because this matters enormously. This isn't a fringe theory. This isn't coming from newsletters in basements. This is coming from J.P. Morgan, from Goldman Sachs, from the World Gold Council, from the research departments of the largest financial institutions on the planet, all of which are documenting the same structural shift in their own research publications. Before we go any deeper, if you're watching this and you have over $100,000 in retirement accounts, an IRA, a 401k, any kind of savings you've built over your career, I put together a free guide that walks through some of the strategies thousands of American retirees are quietly using right now to protect their hard-earned wealth. It's in the description below. Check it out when you're done here. It takes about 5 minutes to read, and it could genuinely change how you think about your retirement security. Now back to the story. Because the most fascinating and frankly alarming piece of this puzzle isn't the price of gold itself. It's what the world's central banks have been doing while most Americans were focused on their stock portfolios. Central banks are not emotional investors. They do not panic buy. They do not follow trends the way retail investors do. They have research teams, long-term mandates, and institutional memories that span decades. When a central bank makes a major allocation decision, it is the product of years of analysis, internal debate, and strategic planning at the highest levels of government. So when you see central banks globally going on the most sustained, aggressive gold accumulation program in modern history and doing it for multiple consecutive years, that is an institutional signal unlike almost anything else you can observe in markets. The numbers are staggering. The World Gold Council reported that global gold demand hit a record total value in the first quarter of this year, with central banks accounting for a massive portion of that tonnage. Poland, China, the Czech Republic, the list of countries actively adding to their gold reserves reads like a who's who of nations that are strategically repositioning themselves away from dollar dependency. Eastern European banks, Asian sovereign wealth funds, emerging market central banks that watched what happened when Russia had over $300 billion in foreign reserves frozen almost overnight following geopolitical sanctions, and decided that the lesson was clear. If your wealth is held in another country's currency, it is subject to that country's political will. And here's where it gets even more revealing. Goldman Sachs published research suggesting that central banks may actually be buying significantly more gold than they officially report. The official numbers, which are already enormous, may only be the visible part of the iceberg. The unreported accumulation, particularly from China, where transparency around reserve holdings has always been limited, could be substantially larger. Goldman's analysts essentially argued that the demand picture for gold, when you account for unreported sovereign purchases, is even more bullish than the already extraordinary official figures suggest. Think about what that means for a moment. The institutions that manage the reserves of the world's governments, the entities responsible for protecting the wealth of nations, are treating gold not as a relic, but as the most reliable store of value available to them. They are doing this systematically and at scale, and they are doing it precisely because they are losing confidence in the dollar's ability to perform the function it has performed since 1971. Now, let's talk about the dollar itself, because you cannot understand what's happening with gold without understanding the deeper structural pressures building underneath the greenback. The dollar's share of global foreign exchange reserves has been declining for years. What was once a commanding majority position has been gradually eroding. The share of global trade being conducted in currencies other than the dollar is growing. The BRICS nations, Brazil, Russia, India, China, South Africa, and now a growing coalition of additional countries, have been actively developing alternative payment mechanisms specifically designed to reduce dollar dependency in cross-border trade. Saudi Arabia, for decades the cornerstone of the petrodollar system, has been openly discussing pricing some of its oil sales in yuan and other currencies. That is not a rumor. That is a documented shift in the policy conversation at the highest levels of one of the world's most critical energy exporters. And American debt is playing a role in this that most financial commentators are still reluctant to discuss honestly. The United States government has accumulated a level of debt that previous generations would have considered literally impossible, a number so large that it requires a certain kind of mental gymnastics to even conceptualize. The interest payments alone on that debt are consuming a growing share of the federal budget, crowding out everything from infrastructure to defense spending to the social programs that tens of millions of Americans depend on. And the only real mechanism for managing that debt load, short of outright default or dramatic spending cuts that no political coalition in Washington has been willing to pursue, is inflation. The gradual erosion of the dollar's purchasing power over time, which is ultimately just another word for the slow transfer of wealth from savers to debtors. This is not a new story. The mechanics of this dynamic are centuries old, but the scale and the speed at which it is playing out right now represent something qualitatively different from anything we've seen in the post-war period. Let me tell you a story that I think illustrates where we might be headed, because history has a way of rhyming, even when it doesn't repeat exactly. Go back to the 1970s. The United States had just exited Vietnam. Inflation was running at levels that seemed unthinkable by the standards of the previous generation, and the dollar was under sustained pressure. The breakdown of Bretton Woods, that Nixon moment in 1971, had unleashed forces that took years to fully manifest. By the middle of the decade, the price of gold had already moved dramatically from where it had been pegged under the gold standard. But even by the mid-70s, most mainstream economists and financial advisors were still treating gold as a sideshow. The real investors were in stocks, in bonds, in real estate. Then came the second oil shock, the Iranian Revolution, the Soviet invasion of Afghanistan. The intersection of geopolitical chaos, monetary excess, and institutional dysfunction that tends to produce the kind of market moves that permanently alter how a generation thinks about wealth and risk. Gold didn't just rise, it exploded. In the span of roughly a year and a half, between late 1979 and early 1980, the gold price multiplied several times over. The people who had been paying attention to the structural signals, the monetary policy excess, the geopolitical deterioration, the breakdown of the old rules, were positioned for one of the greatest wealth preservation events in modern history. The people who had been reassured that everything was fine, that gold was a barbarous relic, that the dollar would always be the dollar, watched their savings lose purchasing power in real time. Now, I'm not saying history is going to repeat in exactly that way. The circumstances are different, the instruments are different, the global financial architecture is different in important ways. But the underlying dynamic, the tension between a fiat currency system that requires perpetual confidence to function and a physical asset that carries no counterparty risk and cannot be printed into existence, that dynamic is very much alive right now, and the signals it is sending are getting louder and harder to dismiss. Because here's the thing about the breakdown of the dollar-gold correlation that we talked about at the top. In the old framework, gold rising while the dollar also held its ground would have been a contradiction, a paradox, something that the models would have flagged as an anomaly that should revert to the mean. But the models are built on historical relationships, and historical relationships assume the underlying structural reality remains constant. What we may be witnessing now is a structural reality that is changing, a world in which gold is no longer moving primarily in response to dollar fluctuations, but is instead responding to something deeper, a global recalibration of what safe actually means when it comes to storing the wealth you've worked your entire life to accumulate. The institutional investors who manage the largest pools of money on the planet, sovereign wealth funds, central bank reserves, the family offices of the ultra-wealthy, are not moving into gold because they expect a short-term trade. They are moving into gold because they are making a multi-decade strategic bet on where the global monetary order is heading. They are positioning for a world in which the dollar's structural advantages are less reliable than they have been, in which the ability of the United States to export its monetary problems to the rest of the world is more constrained, and in which hard assets with thousands of years of recognized value serve as the most reliable anchor in a storm. Now, if you've been watching this video and you've been thinking about your own retirement situation, I want to talk to you directly for a moment, because everything we've discussed so far, the central bank accumulation, the de-dollarization trend, the breakdown of traditional correlations, the debt dynamics, all of it converges on a question that is deeply personal for anyone who has spent decades building retirement savings. The conventional wisdom for American retirement planning was built on a set of assumptions that made sense in the decades when they were formulated. Diversify between stocks and bonds. Let the market compound your savings over time. Trust the system. And for a long period, that approach worked reasonably well for millions of people. But the world that assumption was built on, a world of stable dollar dominance, manageable government debt, and predictable inflation, is not the world we're navigating right now. The geopolitical fractures, the monetary policy decisions of the past decade and a half, the acceleration of de-dollarization, the historic level of sovereign debt, these are real, structural forces that conventional retirement planning doesn't account for. A gold IRA is one of the tools that allows regular Americans, not the ultra-wealthy, not the institutional investors, not the foreign central banks, to do what the sophisticated money has been doing: hold physical gold as part of a diversified retirement strategy. The mechanics are actually straightforward. It works within the existing IRS framework. You can move funds from a traditional IRA or 401k into a gold IRA without triggering immediate tax penalties in most cases. The gold is held in an approved depository, fully insured, fully audited, and it gives you direct exposure to physical precious metals inside your retirement account, the same kind of exposure that central banks and sovereign funds have been aggressively adding to their own balance sheets. If you want to understand how this works in detail and whether it might be appropriate for your situation, there's a free resource in the description of this video that walks through all of it. No obligation, no pressure, just a clear educational breakdown of how gold IRAs actually function and how people are using them to hedge against the exact forces we've been discussing today. Back to the big picture, because we're not done. The most interesting development in all of this, and the one that I think gets the least attention from mainstream financial media, is what the breakdown of the dollar-gold correlation tells us about market confidence at the deepest level. There is a concept in monetary economics, sometimes referred to as the confidence game, the idea that fiat currency systems function essentially on collective belief. The dollar is valuable because people believe it is valuable, because institutions accept it, because other countries are willing to hold it as reserves, because contracts around the world are denominated in it. That is not a criticism. It is simply the mechanics of how modern money works. But it means that the value of the dollar, unlike the value of gold, is entirely dependent on the perpetuation of a set of beliefs and institutional arrangements that can and do change over time. What the central bank gold accumulation data tells us is that some of the most sophisticated institutional actors in the world are incrementally, quietly, but systematically reducing their reliance on the confidence that underpins the dollar system. They are not doing this loudly. There are no press conferences announcing a pivot away from the dollar. There are no official declarations of a new monetary order. Instead, it is happening in the quarterly reserve reporting, in the tonnage figures released by the World Gold Council, in the shipping manifests of gold flowing from Western vaults to Eastern central bank depositories. It is happening in the policy discussions at BRICS summits and in the back channels of energy trade negotiations. It is happening slowly enough that most Americans, who are focused on their daily lives, on their careers, their families, their mortgages, don't notice it happening at all. And that gap between what is actually happening at the institutional level and what most ordinary Americans understand about the monetary landscape is, frankly, one of the most significant financial risks that any individual saver faces right now. Not because a collapse is imminent, not because the dollar is going to zero next week, but because by the time the shifts we've been describing become obvious to everyone, by the time they are on the front page of every newspaper and being debated on every financial television program, the opportunity to reposition your savings in an intelligent way will have largely passed. The central banks are not waiting for that moment. They are already acting. And the question for anyone watching this who has retirement savings to protect is simply, what are you waiting for? The investors who understood the 1970s monetary dynamics early didn't just avoid losses. They transformed what could have been a devastating decade for their wealth into one of the most significant wealth-building periods of their lives. The investors who waited until the signal was obvious, until gold was on the cover of every magazine, until every taxi driver was talking about precious metals, bought near the top and suffered the consequences of the inevitable correction. We are living through a period that a significant number of serious analysts and institutional strategists believe will be looked back on as a major inflection point in the history of global finance, a period when the structural underpinnings of the post-1971 dollar system are being genuinely tested for the first time, a period when the question, what is real money, is being asked not just by retail investors and financial commentators, but by the treasury departments of sovereign nations. Gold is not rising because speculators are excited about it. Gold is rising because the world's most sophisticated financial institutions, the central banks that hold the reserves of nations, the sovereign wealth funds that manage multi-generational wealth for entire countries, are treating it as the most reliable answer to that question. And the fact that gold is managing to sustain its extraordinary performance, even as the old inverse relationship with the dollar breaks down, tells you something profound about what those institutions believe is coming. The dollar's real gold problem is not simply that gold is going up. It is that gold going up in the way it has been going up, driven by sovereign accumulation, by structural de-dollarization, by the quiet but unmistakable loss of confidence in dollar supremacy among the world's biggest institutional actors, reflects a set of dynamics that no Federal Reserve press conference, no Treasury Department statement, and no financial media reassurance can simply talk away. The problem is structural. The problem is geopolitical. The problem is mathematical, rooted in debt dynamics that have taken decades to build and will take decades to fully resolve. And it is getting harder to ignore. If you've watched this far, you're clearly someone who takes their financial security seriously. And I want to give you something real. In the description of this video, you'll find a link to a free guide that goes deeper into everything we've covered today, specifically focused on the strategies that informed American retirees are using to position themselves ahead of the forces we've been discussing. If you reach out through that guide and mention that you watched this video, we're offering a complimentary one-on-one educational web conference. No obligation, no sales pitch, just a genuine conversation about what these macro forces mean for your specific retirement situation. This is available exclusively for American retirees who have at least $100,000 in any retirement account. The reason for that threshold is simple. This is the kind of personalized, detailed analysis that only makes sense at a certain level of assets. The central banks understand what's happening. The sovereign wealth funds understand what's happening. The question is whether the rest of us are paying attention before the window narrows. The dollar's gold problem got harder to ignore today. Make sure you don't ignore it either.